we're not at the end of the downturn in credit. We're at the beginning. And it's unclear, right? It's absolutely unclear, to directly answer Darius's question, how long the downturn will last. There's a million factors that go into this. All you can do is, you evaluate the data that's coming in, you look at the trend that's taking place, and, once you start to see, so we're at the very beginning where things are just starting to get a little worse. So I'm pretty sure they're going to keep getting worse for quite a while. Is that quite a while? 6 months, 12 months, 18 months? I have no idea. But what I do know is that, this stuff has very clear patterns to it. We follow it really closely. And when the rate of change and deterioration begins eventually to start to flatten out and soften, that's when you're going to start to hear from us the green light to get back in the water. But right now, you don't want to be anywhere near the water. This is just getting started.
Yeah, it's interesting. I mean, and you, for those of you that don't know, Josh was like the bull when he started at Hedgeye. Shortly thereafter, as the jobless claims, curves really started putting in bottoms. He was very bullish on Capital One, Discover. These are pro-cyclical stocks. What does pro-cyclical mean? When people start to, they're cyclical stocks that people deal with pro-cyclically, I should have said, which is basically, at the lows of the cycle, you buy them. At the end of the cycle, you sell them. If you would have done that with any of these stocks, Capital One, Synchrony, Discover, and sold them, at the peak of the cycle was July, don't forget. And you can go back, you can look at all these, and that's precisely what happened. Isn't it interesting, Josh, that you'd also, like, if you take the three big parts of what happens at the end of the cycle, basically employment gains start to slow. That we've seen that in non-farm payrolls for 3 consecutive months. You've seen it in JOLTS. You've seen it in Janet's preferred change in labor market conditions index hitting a new low of minus 4.9 in May. You obviously start to see some level of deterioration or slowing in both real consumer spending and income growth. But again, those have kind of been passive-aggressively slowing, not crashing. And then you see stocks that are related to those things all crashing, which is, again, the point on consumer credit is that once it starts going down, it doesn't immediately bounce and go back to the highs.
Yeah, it's the other thing I would flag, and this may go over people's heads a little bit, but I'll try and sort of contextualize it so it's straightforward. There's this important phenomenon in lending called the denominator effect, and what
I think people will get that.
What it means is that when you have companies that grow rapidly, so when you have lenders that grow rapidly, there's a numerator and a denominator in calculating these charge-off rates, which is what Synchrony was guiding to and everybody got freaked out about. And the idea is that your numerator is your bad loans, right, either your delinquencies or your net charge-offs. But your denominator is the base of loans into which you're dividing that, right? And obviously, delinquent loans show up on a lag, right? And if you're growing the denominator very quickly, which is exactly what's happening right now, right? So you've got 13% year-over-year loan growth. You're inherently understating the sort of weakness in the credit performance, right? And that's just the math of it. And so what's interesting is that Synchrony is guiding up their charge-off rate at a time when their denominator is growing as fast as it ever has. That's a really worrisome indicator, and I think that's a lot of why the stock was down so much yesterday on what seems like a pretty small increase in the charge-off guidance. And so, in other words, what you're really going to see is when these loan growth rates begin to slow down, which they will over the next 12 months, they'll slow down dramatically. Then you're going to see a small explosion in the increase in the charge-off rates. And that's a really important thing to sort of understand, because when you look at the stocks, right, the multiple is going to compress right alongside that charge-off rate and delinquency rate. So anyway, that's the gist of it, and that's what I'd be watching out for over the coming 12 months.